Welcome, everyone. Welcome to the CoinRock Show. It is Thursday, and we have a guest coming up in about 25 minutes. Let's push this out. The team is on. Team should be you should be good to go. And there you go. You can push this. All right, good. So, welcome. The market is looking a bit choppy, but let's not complain because we've had a really nice leg up over the last few weeks. It's been good. It's been good. I think that it's setting. I think the market is is getting ready. I think we might see a small pullback. By the way, if you're trading on the hourly or the daily, I think I wouldn't be surprised to see a small pullback. But overall, I think this is super bullish. Let me just have a look at the mic here to make sure that we're good. Welcome everyone. Drop a comment. Say hi. Don't be shy. Say hi. We are good. Okay, so we'll be on for about 25 minutes now, and then we'll be joined by our guest, who is who's really big into the macro. He's an analyst, so it's going to be interesting to talk about market cycles, Bitcoin, of course, commodities too, because he's also he comes from traditional finance. So prices, yeah, I mean, look, I think that we're in a really good place. I think the market's in a good place. Not surprised to see this kind of, if you look at the daily, probably stagnate, and you may be frustrated if you came in as a late long over the last week or so, especially over the weekend. I think that we are due for a small pullback, just because again remember, like a few weeks ago we were at high 70s. Bitcoin was struggling. I think we touched 78K. We were live on here, and Bitcoin was like dropped under 80,000, and now we're at over 100,000, back to 100,000. And actually, I saw a tweet yesterday. I think yesterday was the first time that Bitcoin was over $100,000 for more than 5 days or more than 6 days. So it's looking good. I mean, you see the same thing. There's no euphoria in the market. Retail is still not super interested. I think this is great. This is a very good place to be at. Shout out to Ethereum. Talk a lot about Ethereum. Very bullish on ETH, just because I think it will have a face melting rip and rally at some point. I mean, it's up like 80% almost over the last month or so. I think we were hovering around the 1500s for ETH. Did we drop into 1500? I think we dropped maybe briefly, but say around the 1500s, 25, 2600, 2700 even. So, it's looking good. Overall, I think that we see, like I said, a small pullback, and it's fine. I think it's overall it's due, like I said, for like we need to go in think of this as basically the next step up of a very long staircase up. So if you're looking at the bubbles here, everything's red, but the sentiment is overall, let's take a breather. Solana's at 171. I think we crossed 180 or just got close to 180 over the last few days. So look, I'm very I said this, right? We talked about this for months now. I think as soon as we see some more certainty or at least, like I said, less uncertainty in the markets, we'll see some good price action. That's exactly what happened. So let's see what happens now. Of course, everyone's watching the U.S. Trump, the tariffs, the 10-year. So it's funny because as much as you want crypto to rip, there's, like I always say, crypto is just like it's a small boat in on the ocean, in the middle of the ocean. and all these bigger markets like commodities and stocks and bonds and real estate are these huge tankers. And so we are, and of course the U.S. economy and all that, these other factors are these huge tankers, and of course everything that happens to them has a ripple effect, and that's why crypto is so volatile. It's a small boat in a big ocean. So yeah, I mean, look, I'm very bullish. Like you guys know, I don't trade the daily. I just think that if we don't see a quote black swan event or something catastrophic, I think this is a very, very good setup for the next few weeks. Welcome everyone, Kobe, Mark, Shia, and let's push this out to all the other groups too. Let's see. And we will be joined in about 20 minutes by our guest, the Peruvian Bull. Let me just push this into one of the groups here. There you go. So, okay. Let's have a look at some of the headlines here. Everything, you know what's funny about the like the news, if you actually take a step back and you look at the headlines over the last few I'd say, well, a few months, but like specifically the last 10 days or so, the headlines are not more bullish than before, right? You know this. If you're a frequent, a regular attendee and you watch the CoinRock Show, you know that we've seen these bullish headlines for months, right? Nothing new. But price actions, of course, everyone's in a better mood when price action is better, right? So I shortlisted a few articles here to go over. Number one, ETH. It's actually a relief to see the ETH Foundation doing something and being more proactive over the last few weeks. Definitely gives more belief. You know, when you run projects and companies, you have to communicate, even if you're not the best at communicating, or if you haven't done a great job. Like ETH has done a horrendous job for years, like catastrophic. I don't know who's running PR over there, but you know, I think they got the words. I think they understood that we need to do something, otherwise this is going back to zero. Not zero, but you know, it's been down only for months. So this came out this is today or yesterday. Ethereum launches $1 trillion security initiative to fortify a network. The ETH Foundation has unveiled a sweeping new initiative aimed at overhauling the network security framework to support a future where trillions of dollars can be stored and transacted on-chain. This is actually really good branding, by the way, the $1 trillion security initiative. It's great. It's great framing. Great. This is good PR. Good work. What will it do? Look, we can go into this, but I'm sure if you hold ETH, the only thing you want is like number to go up. So what will the $1 trillion project do? Security project do? Security initiative do? Mapping the landscape of security strengths and attack vectors across every domain and layer. Okay. Number two, executing on improvements. And number three, communicating more effectively. Good. Communicating more effectively about Ethereum security. Users of all kinds should be able to understand, utilize, and benefit from Ethereum's strong security foundation. Looks like someone got the memo. Maybe we should communicate more. So good to see this. This is something that they could have not showed at all. I don't think this is like groundbreaking. I think this is something that could have easily been ignored and not published. The fact that they're publishing this type of news is very bullish. It means that maybe they finally understand that you actually have to talk. You have to talk your book. You have to push. You have to market. Otherwise, the market is so noisy now. There's so many new launches, new TGEs, new projects, new raises, that if you're not constantly pushing news out, especially if you have news and updates, people move on. Simple as that. So that's this is actually a good example of them waking up. Another one, we've seen this a lot over the last few months. Another state in the US, Nebraska advances bill to regulate crypto mining power use. So again, is it life-changing for you guys if you hold Bitcoin, crypto? Not really. But it's bullish. It's another bullish headline. That's how you have to think and how you have to see these updates. Nebraska is on the verge of enacting sweeping new regulations aimed at curbing the impact of crypto mining on the state's power grid. Good. So again, the whole point here is states, decision makers are actually doing something and being proactive into welcoming crypto. And in this case, it's more about crypto mining and the weight that it places on the power grid. This is very good. Why? Because Nebraska does it, and then another state does it, and then 5 other states do it, and then a country does it. We talked last week with an OG Bitcoin miner. You guys should watch the episode if you weren't live. I mean, it was fascinating. I think that unless if a lot of these miners, actually guys who are in the trenches of mining, like they're usually pretty private people. So to get the alpha on how that industry works, that within the crypto industry, like that, how that sector, the mining sector works, is very interesting. And yes, there is real potential if states and countries understand how. And and last week on the episode we talked about how it can help actually countries help the power grid if it's well set up, help use and reuse basically wasted energy. And this is very good. One state, and then another state, and another country, another 5 countries, another 10 states, and slowly but surely this adds up. So this is good. So moving on to SEC delays Solana ETF. So this was a bit more of I'd say a bit of a bigger headline, just because Solana is Solana is the winner of this cycle, right? If you look at price action, went from $8 in the bear, and now we're up to at 170 now, but it peaked at what, $270. So that's what, a 40x, 35x for a large cap. So it is definitely the clear winner so far. ETF, of course, one of the main conversations of this cycle too. A lot of ETFs, including meme ETFs, talked about that. I don't know if I'm bullish on meme ETFs, but if it's a product and people want to buy it, someone's going to make that product, basically, right? So this is the Solana ETF here. There's several, but the in this case, so headline here: the SEC has delayed its decision on Grayscale's spot Solana ETF and pushed it back to October. I don't think it's bad. I mean, we've seen this happen, right, over and over again. I really don't see any issue. We've seen this over time too. Like Bitcoin was, of course, very different time with Gensler being at the SEC, but the move mirrors the SEC's historically cautious approach to crypto-backed ETFs, even as investor demand for regulated digital asset products continues to grow. Nothing out of the ordinary. The commission is instituting proceedings to allow for additional analysis. They've done this several times, so we'll see. I think it's inevitable. I think that after Bitcoin and ETH, the next one to get an ETF is going to be Sol. I think it's no secret. I think everyone thinks that. If there's talk about meme ETFs, Solana is getting one at some point. Is it next week? Probably not. Like we can see here. Is it going to be in a few months? At some point in the next 6 or 12 months, there'll be several ETFs approved for Sol. I think it's very clear now. The SEC's green light for spot Bitcoin ETFs in January helped push Bitcoin up to over 50K. So it is a bullish catalyst, right? So look, we'll see what happens. I think that it's just a matter of time. I think it's kind of like it's bullish, and it's just a matter of time. It's inevitable. That's why I'm almost like blasé. It's like it's gonna happen anyway. So, this is something that if you're on the outside of the industry, you would see this as like, oh yeah, why are they delaying this? But if you guys are on the inside, if you watch these shows, you follow the show, we don't talk about like, oh, this next coin is going to the moon. We actually, something that I'm actually very proud of, the way we've built CoinRock Media so far for the last 4 months now is, and this is kind of like a side note, but like consistency is a big deal. We show up at least twice a week. It's a commitment, not ideal timing. Sometimes I have to drop off team calls. Sometimes I have to do something else, and I have to, but I have a commitment. I think I had to cancel once, I believe, because I was like crazy sick that day. And so my point here is we've brought you and we keep bringing you guests that we could really charge and put everything behind a paywall. We actually had this conversation internally. Do we create like a CoinRock Alpha, like a paid, like CoinRock Plus, maybe at some point? But definitely not. That's definitely not the strategy for what we're doing now. So yes, these guests are like valuable. There is incredible education and value, and we tell the guests like we don't want the show to be a shill fest. For us, it's like overall, if you look at the majority of the guests, the value and the education is very high, right? So that's important to me. And so with that said, if you've been following the show, you know that it's inevitable. There will be a Sol ETF. It's going to happen. Is it in 2 months, 6 months, 12 months? No one knows, but it will happen. Bitcoin happened. The ETH ETF is. I mean, look, you can see when you see the big boys like BlackRock buying ETH, and you can see the ETH staking and the ETF and that whole thing happening in the next few months. As soon as there's more clarity, and that's also one of the reasons why we'll be seeing more of these delays too, is the SEC has committed to giving clarity to everyone, basically mainly to the market, yes, but also to the industry, so to the the founders, teams, and the fact that they delayed this until October gives them time to come out with the full framework, which is due around August, September, from what I'm hearing, which times it perfectly with this. So I think they'll come out with the framework first and then say, hey, these are the rules. And then after that, okay, let's move back to approving or asking for more information about these for these ETFs. So yeah, it's gonna happen. If it's not Grayscale, it's someone else's ETF. I mean, Sol will have an ETF. Again, the only caveat is if the industry goes to zero. But look, there's always a risk, right? But that being said, I think that the risk today of it going to zero is low. No guarantees. You're big boys and big girls. You do whatever you want with your money. You're responsible ultimately, but the truth is it's just a matter of time. Last one here, VanEck, and then we'll take a quick 5-minute break, and then we'll be joined by our guest. Let me just have a look here to make sure that. All right. So this is another headline here about, again, institutional interest. We talk a lot about institutions. We've had several guests work directly with these funds, directly with these institutions. And VanEck here launches blockchain-based treasury fund for institutions. Again, this is what allows big funds, pension funds, VC funds, like venture capitalists, private equity, old school funds, family offices to come in and actually deploy large amounts of money. It's having these large players green lighting and saying that, yes, it's okay, it's safe, you could come in now. And so VanEck has been very bullish for crypto, very bullish on not just Bitcoin, but also actually they published quite a few updates on Sol. Global investment firm VanEck has entered the tokenized asset market with the launch of V-Bill, a blockchain-based treasury bill fund. Sorry, just reading three things at the same time. Targeting institutional investors. Announced 2 days ago, the fund supports 4 blockchain networks. So again, what I want you guys to understand is that, because so many things are happening in the space, there will rarely be a single headline that full sends the market. Maybe we'll see like a crazy, like I think the biggest catalyst for the next leg up, and I'm not talking Bitcoin going over $110,000. I'm talking 150, 200K is going to be a better and more bullish risk on macro environments. So these headlines will not full send today, but you put hundreds of these updates and headlines and moves in the industry, and everything's going in the right direction. So again, very bullish on this. SEC chair backs tokenization as market disruption. If you've been in pain, and I know there's been a lot of pain over the last few months when it comes to price action, I think it's important. I've always tried to be cautiously bullish or bullish but cautious, and telling you guys that mid to long term, this industry, if everything goes just like stays in this direction, there will be a Bitcoin over $300,000, $400,000, $500,000, an ETH over $10,000, $15,000, $20,000. I said this in one of the groups, one of the private groups. I said, for ETH, this number of ETH to $10,000. So now it's sitting around what, 20, 25, 2,600. If Bitcoin is at $300,000, $400,000, $500,000, ETH will not stop at $10,000. Simple as that. So I think that there is a scenario where ETH hits $15,000, $20,000 plus. Probably not the cycle, but looking at Sol, $1,000, $1,500, $2,000 Sol. I mean, why not? Why would Bitcoin take hit 3, 4, 500,000, and the other more risk on assets? Why would they not take multiples of that? And you know the answer. Whether it's ETH at 14,000 or 12,000 or 16,000 or 9,000, it's going higher. Same for Solana. Same for XRP. We don't talk about XRP a lot, but I have a few friends who are very bullish XRP. And these are not like, they know XRP is not going to $500, but $8, $10, $12, very realistic. If we see a really, really bullish run and Bitcoin hitting, $200,000, $250,000, yeah, XRP, it's $7, $8, $10, $12 realistic. So that's what's very interesting to me. Is I'm not interested in the next few weeks, next few months. We'll see. Maybe we see a crazy run this summer. I hope look, if you're in this industry, you want to see price go up. That's why we're here, right? So of course the tech is one thing, but no one's staying in an industry where the tech is interesting but there's no financial returns, right? Simple as that. So ultimately, the reason why these institutions are coming in is because they see this as a new space that they can sell to their clients, that they can invest in, and this is the new basically digital money, right? The era of digital money. So I think that, and Shai is saying, never-ending pain. You will look back at the pain that you guys have had to endure, depending on the bags you have and when you bought. it's not just about the bags. It's just like when you actually bought. If you bought the top, you bought the top. I mean, nothing you can do, right? Everyone's bought the top at some point. You will look back, and if you stay, and that's why, you know, I've been saying this for months too. I say that if you stay in the market and you survive and you just stay focused, locked in, like Gen Z says, if you're locked in and you just keep reading, keep studying, keep, yes, doing some research, you know, connect with other people in different groups that you're interested in, different assets, tokens that you're looking to buy, you put yourself in a position that increases the chances of winning. Simple as that. And versus the tourists who left in January and then will come back when Bitcoin is at $165,000 and, you know, everything's pumping, and they'll be like, hey, you know, should I buy Bitcoin? And they don't buy at 165 and they buy at $220,000 Bitcoin. Like, yeah, you're gonna have some pain, bro. But everyone has to go through that. So again, use the time. And again, it's nice to see, you know, Solana actually dropped under $100 a few weeks ago, 2-3 weeks ago. We were at 99, ETH 1500, Bitcoin high 70s. So we're looking good. This is good. Like, let's take a breather, and then, you know, if we can move higher, I think we're in a very good spot here. All right, so the team just pinged me. We'll take a quick break. Let me just pause the screen here. We'll take a quick break. We'll be back in about 5 minutes with our guest, and we'll talk macro cycles, so macro and market cycles. 5-minute break. Stay tuned. We'll be back. Hey, Matthias here, and if you're enjoying this and want access to even more alpha, early stage deals and opportunities, and also behind the scenes insights on the markets, hit the link in the description and make sure you're subscribed. It's free and it puts you ahead of the curve. Let's get back to the show. Perfect. There you go. Welcome to the show.
Thank you. Thanks for having me. Excited to be on.
Very cool. Yeah, I was just having a look at some of the things that you've done. Definitely want to talk about the documentary. So quick intro. The Peruvian Bull here is, I want guests to do their own intro just because you know your story, of course, better than anyone. The reason why we really wanted to get you on the show was because you have a background in, of course, macro cycles and you know, being an analyst and understanding monetary policy more than many people on crypto Twitter. And I think, you know, whenever we see Trump or the Fed coming out with updates, everyone becomes an expert in monetary policy. But you actually have been doing this and studying it and writing about it for longer than most. So definitely want to get more into that. So again, the floor is yours. Go ahead, give everyone an overview of who you are, what you do. Go ahead.
Sure. So my name is Peruvian Bull. I'm a macro writer and analyst. I've been studying macro for about the last 7 or 8 years. I used to work professionally in a fintech as an analyst, as a valuation analyst, and modeler, building out valuations for private startups, and I did that for several years, and then I decided to quit and do this full time. So I've now been full time for almost 2 years now, making macro content. I have a YouTube channel and a Substack where I produce all my macro research, and then sometimes as well do one-off engagement for institutions like hedge funds.
Nice. We'll link everything around the video, but I'm sure if people go to YouTube and type in Peruvian Bull, they'll probably find you.
Yeah, I'm pretty easy to find. Cool. There's only one Peruvian Bull.
Nice, very cool. Definitely a very catchy personal brand name. So yeah, so we'll link everything. Of course, anything you mentioned, we'll link to around the episode and the articles coming out about the conversation here. So let's dive in. You know, let's talk about the macro for a bit. You know, this is it's a very interesting cycle. with, of course, institutions coming in. I'm curious to hear your take on so far this cycle when it comes to everything that people talk about on Twitter, which is the macro, tariffs, monetary policy. How do you view the last 6 months of what we've seen in the markets?
Well, I would say it's been very interesting, right? I mean, the Fed and the monetary authorities in general have been bucking the trend of typical monetary policy for the last few years, right? We had basically a historic easing cycle in the wake of COVID-19, where they flooded the markets with liquidity and tried to, basically push demand forward, and allow that demand, or pull demand forward, and that allowed them to restart the economy after the lockdowns. But it unfortunately led to that huge wave of inflation that we saw in 2021 and 2022, first coming out in the PPI numbers, and then obviously eventually leading out into the CPI and general consumer prices. And so their response obviously was the dogmatic Federal Reserve central banker response, which is raise rates, restrict capital, right? Start tapering the balance sheet aggressively. And it did work. The problem is it started to work too well and things started to break. So we saw, obviously the yen and the pound breaking in September of 2022, causing emergency actions by their respective central banks. And then in 2023, we had the SVB banking crisis. And so that prompted the Fed to create all these emergency liquidity programs in order to basically address the overall issue that was being faced by a over leveraged financial system that didn't have enough liquidity. And now we're at this kind of like weird doldrums point, right? Where they've been, not the last several meetings, but this last, Fed meeting in early May, and as well as that there was one Fed meeting last year where they slowed the rate of the taper, which has been like their consistent way of reducing, their monetary tightening, not in like a net sense, but in at least a rate of change sense. And that's allowed them to buy more and more time for them to keep rates here and hopefully put the nail in the coffin on inflation. Although some of the figures that have been coming out of 3%, 3.2%, like these aren't these aren't as encouraging as I think that they want them to be, because they're showing that inflation here is sticky, and that's all because we're in a secular inflationary cycle. There's going to be, in my opinion, this decade we're going to have multiple waves of inflation, just like the 1970s, and they're going to get increasingly worse because of the fiscal and debt situation of the United States, and that debt needs to be monetized somehow. So the Fed's going to have to do QE again, and that just means that there's going to be more inflation down the road. And so there's kind of a paradox there where their higher rates will actually make things worse in the long term.
For people who are just joining or new to crypto, or new to the financial space in general, how does liquidity work? What is liquidity? What does it mean when the Fed removes liquidity as liquidity, and the impact on crypto and commodities? Because I know you've also written a lot about that too.
Absolutely, sure. So the way to think about liquidity, right, is cash available to trade for securities. And when the Fed does QE or when they do QT, what most people think of them as like doing money printing in the traditional sense, but that's actually not what they're doing. What they're doing is they're creating what are called settlement balances or bank reserves. And those bank reserves are swapped for assets on commercial bank balance sheets, right? Mainly the primary dealers, which are the banks that deal with the Federal Reserve and the Treasury buying and selling government bonds. But also, obviously, financial institutions across the board, because they're also buying MBS, and they also sometimes buy other bespoke instruments like agency ABS, which are asset-backed securities, as well as agency MBS and other smaller issuances. But what that means is that when they do QE, they're basically creating these bank reserves, which are essentially like money for the financial system. It's not money that you or I could spend in the real economy, but it's money for banks. It's money for institutions that they can use to buy and sell securities. And that money will flow out and, basically you could say flood or fill up all these balance sheets. And as these institutions need to deploy capital, this means that they have to go out and invest. And of course, some of that money flows into bonds, some of that money flows into equities, but on the margins, obviously, some of this money flows into crypto. And since crypto is especially, a very nascent and small industry, at this current juncture, that means that the percentage price gains are pretty significant whenever there's an easing cycle. So if you track, for example, global liquidity in Bitcoin, you can see that a 20% spike in global liquidity that we saw in 2021 obviously led to like a 400% rise in the price of Bitcoin during that 2-year period from 2020 to late 2021. And the same thing has been true with previous easing cycles, although it's been getting obviously a more pronounced effect. And that effect is also seen in SPY, in QQQ, and basically all the Mag7, all the larger tech names. Those are also liquidity, proxies for liquidity. And overall, this has meant that the stock market in general has become very sensitive to liquidity because of this kind of monetization of financial assets from the Federal Reserve. And so, the correlation coefficient between the Fed's balance sheet or their net liquidity and the S&P 500 is now 0.88, which is extremely high. That means basically 88% of the time when the Fed's easing, they're going to be going up within that week or 2 weeks. So, it's not an immediate indicator that you can trade like, RSI or something, but it is it's like a general headwind or tailwind for markets. And so when the Fed is easing, it's like buy everything because everything's going to get bid up. All this money that's flowing into the banks is going to flow into private equity and venture capital and smaller hedge funds. And then all that, is going to be eventually siphoned off into crypto as well, which is going to cause everything to rise.
Yep. So a few weeks ago, the Fed came out with what you said, of course, the reduction of QT, right? Slowing down. Explain what it means. A lot of bad takes on Twitter too came out that day too. QE's back. What actually happened?
Sure. So what they did is, obviously, like they didn't, even though a lot of people misinterpreted that move as a QE, it's not actually QE. And I'll get into. They're doing some creative things behind the scenes to actually, let's say, stymie the effects of their own tightening. So they're trying to do stuff to counterbalance it. So in reality, like net liquidity kind of it's been flat for like a year, and it's because of these like tricks that they're doing, monetary tricks behind the scenes. But in terms of the last Fed meeting, what they announced was a reduction in the pace of QT. And so that just means that they're rolling off the bonds off the balance sheet at a slower rate. And so whereas previously, they were rolling them off, let's say last year at like 90 billion a month and then 60 billion, now they're reducing it even further. And so that means that the tightening is happening at a slower rate. And the way that, QE and QT work functionally is you can think about it very simply. Like I said, think of it as like a swap, an asset swap between the Fed and a commercial bank. So like JP Morgan, when the Fed does QE, they create a bank reserve or settlement balance, let's say for $100 million, and they swap it for $100 million worth of treasuries from the bank. And so the bank gets $100 million of bank reserves, and the Fed gets $100 million of treasuries. And so what this means is that the overall size of the banking system grows, right? Because the Fed just created a bank reserve out of thin air. Now, when the Fed does QT, the opposite happens. So they're essentially, they allow an asset on their balance sheet, which is their bond, right, to roll off. And then they reduce their liability, which is a bank reserve, by the same amount. And so that means that whenever there's QT, the overall size of the banking system falls, which means that there's less liquidity overall because there's less bank reserves, but also obviously less assets on the Fed's balance sheet that they can hold. And so they've been doing this to withdraw liquidity for last 2 years, 2.5 years or so, and it's been pretty effective, right? We've seen a reduction in overall headline inflation as well as PPI inflation pretty steadily here for the last 2 years, and that combined with high rates is pretty restrictive policy.
I want to get to your story, so come back to basically you and how you got into this. Everyone has an origin story of fintech, but then also how you got into crypto and then making the switch, basically, because not everyone goes from TradFi to crypto. And then talking about the tricks that the Fed is pulling. I'm sure the audience wants to know more about that, specifically because there's so many takes on Twitter and it's very difficult to know what the truth is. You see KOLs who, I know many KOLs, and the majority of them don't know anything about the actual financial system. So I want to have takes that people can actually really listen to and trust when it comes to the policy itself. So, but your story, what got you initially, if we take a step back, how did you get into the financial space?
Sure. So my family was extremely affected by the 2008 financial crisis. I'm the youngest of four brothers, and my older brother, my second oldest brother, had a real estate company, a brokerage up here in the Pacific Northwest that was running very well prior to 2008, and it during the bubble collapse, his business was basically destroyed, and he basically had to move back in with us, and he lost everything, right? And so it was a very difficult time for him, and I saw that impact on my parents as well. And so as a young man, I was very concerned, because I was like, what caused this? What could be the forces that would create this amount of economic pain, and what led to that bubble? And so in the mid 2010s, I started researching the 2008 banking crisis, and that led me into banking, and then that led me into finance and economics and macro, and then Real Vision and Macro Voices and all those guys. And so I've been studying this, like I said, for 8 years at this point, really at a consistent level. And so I decided to switch my major in college from biology actually to finance and economics. And then I worked for an insurance company for a brief while as a data analyst, and then I switched over to a fintech and was a valuations analyst and valuations model builder for a couple of years, and then I quit my job. But I've always been fascinated by how markets work, the interplay between the Federal Reserve and and equities and commercial banks and all this stuff. And really, I think it's like macro is a search for the truth, right? Like this whole field is trying to find what's real, because there's just so much narrative and so much BS that's out there. And after years and years of trading and trying to make money with macro, I've found that there's honestly about 10% of people that are worth listening to, and the other 90% you can just ignore, because most people aren't able to find signal through the noise, and it is difficult. It's very difficult to do. So that's been my experience with macro.
Yep. And switching to crypto, so aside from TradFi, going from traditional markets to crypto.
Yeah. So I was exposed to Bitcoin in 2017. I've also bought some Litecoin, during that bull market, and I sold and I made like 3 or 4x, and I thought I was a genius. And, I basically passed it all off as a bubble, right? As a rational exuberance phenomenon. And I was reading books about, the history of monetary bubbles or financial bubbles. And so I kind of passed it all off as a bunch of nonsense, right? But in 2021, I was part of the GameStop community on Wall Street Bets, and I saw the massive, manipulation in the stock, as well as the blatant lying from MSM, and just the corruption in the legacy financial system, which I'd been aware that the system was broken, but I didn't realize how broken. And that event really woke me up, because I thought, man, if they can shut off the buy button for GameStop or for AMC, like
with no repercussions, none.
Yeah. With just fines. Yeah. Just a little bit of nothing. No one goes to jail. No one's held accountable. That event should have been like, no, there should have been like riots in the street, and Vlad Tenev should be like serving life in prison for that. And same with senior executives at Robinhood and Interactive Brokers and, Apex Clearing, which is the main clearinghouse that shut down retail buying for 160 retail brokers. So that event really woke me up, and I was like, holy shit, maybe I need to look into this crypto stuff a little more. And so I read, the Bitcoin Standard. I read a bunch of other documentation on crypto. I started buying ETH and AVAX, and then also Bitcoin. And by that summer, I was completely crypto pilled. I was like, I'm ready to dive into this. And I was just basically putting most of my paychecks into crypto. And so I realized that this was the future of the financial system, and that we need, decentralized blockchain, decentralized ledger to stop this thievery, this grift that's so common if you have a centralized system, right? Any centralized system, the powers that control it are going to try to use it to their own advantage. If not now, then eventually. And that's where we're at right now.
Yeah, very cool. Going back to like the Fed, right? So let's talk about the tricks. What are they doing that many people are missing?
Sure, absolutely. So I've written about this in several Substack pieces, but they're doing several creative things to, basically buffer their, loss of liquidity, right? Because like we
Yep.
said, with them doing the QT, they are meaningfully reducing the liquidity in the banking system, because when they roll off a bond off their balance sheet and their balance sheet reduces, they also have to
Mm,
reduce their liabilities, right? Because the universal accounting equation is A equals L plus E. Assets equals liabilities plus equity.
yep.
So their equity doesn't change. And so if their assets change, then their liabilities, which are bank reserves, which is cash essentially for the financial
Yep.
system, has to change. So they started with, obviously their drawdown of reverse repo and the TGA back in 2021 and 2022. So as they started this tapering process, especially through 2022, 2023, they started drawing down on reverse repo in a very, very meaningful way, which was adding cash back to the banking system, because
Hmm.
repo essentially involves all this cash that gets parked at the Fed to swap for treasuries as collateral. And as that figure gets drawn down, more and more cash is added back to money market funds and primary dealers and what are called authorized participant balance sheets, right? So all their
Yep.
balance sheets can re-swell. And so the Fed basically allowed the reverse repo to be drained slowly. And same with the TGA, by the way. The reverse repo was at like 2.
What's the TGA for everyone here?
TGA is the Treasury General Account. It's the checking account for the federal government.
Yep.
And it got filled to a massive war chest, right? In the aftermath of the QE infinity. We could call it QE4.
Yep. Yep.
And so it was up to about 1.8, 1.9 trillion, and reverse repo was north of 2.2 trillion. So all in all, right? Like that's
Yep.
$4 trillion of liquidity that they could draw upon. And so that's the irony, is that even though, like, at the same time that they're lowering the balance sheet by trillions, they have all this extra ammo in the
Yep. Yep.
in the chamber to use. And so the TGA, the way obviously it works is like all this money is trapped at the Fed, and when the TGA is drawn down, that functionally means that cash is flowing out to the Treasury, and the Treasury is
Mm,
using to spend on, government programs, war, entitlements, infrastructure, whatever. But
yep.
what that means functionally is obviously that money flows back out into the real economy and basically into the banks, right, as deposits. And so that's more
Yep.
liquidity for everybody. And so it just meant that the Fed had these two new liquidity pools that they could draw upon. The other thing that there's a couple other things that they did. One was, which most of the people missed, but I was able to catch, fortunately,
Yep.
is if you have a chart, and you can look on my Twitter profile, just search on my profile Banana Republic, and it should be like the first or second tweet that comes up. If you search the Fed's balance sheet and you create a year-over-year stacked, rate of change chart with, broken down by maturity, you'll see
Yep.
basically like the blowout in each maturity as the Fed does QE. And when the Fed switched to QT, you can see that, the 1-year bills, the 2-year notes, the 5-year and 7-year notes all went negative, meaning like year over year, they were getting rid of them, right? They were laying them off. They were allowing them to fall off their balance sheet, and they were deleting bank reserves as, compensation for getting rid of these assets. The one line item that didn't decrease year over year was the bonds over 10 years. And
Yep.
so that tells me two things, right? That means that the Fed was able to taper, in the sense that they can lay off the short-term debt. They can get rid of the bills and the notes. They can't get rid of the bonds, which are everything past 10 years. So that means that the market demand, the structural market demand for long-term bonds is very weak. And if the Fed allowed those bonds to be laid off, meaning like, get rid of them, enter the market, like either sell them or just let them, mature and expire, then that means that the yield would have blown out to a very significant level, and the Fed did not want to allow that to happen. And so their monetary mechanic was, let's reduce the bills on the short end or on the
Yep.
front end. Let's increase or keep steady the long end. And since our overall balance sheet is falling just because of the amount of decrease in the bills, no one will notice, right? No one will catch us doing this kind of monetary experiment. And
Yep.
it worked. Most people did miss it, but I caught it. And I think it's the other reason why it's so important and impactful is because when banks buy bonds, right, they have to hold a certain amount of capital against that bond in case the asset price fluctuates. And
Yep.
the longer the duration of the bond, the more capital they have to hold against it because of something called, duration risk, right?
Yep.
There's a positive convexity in the bond value towards interest rates and towards duration, meaning the longer the duration and the bigger the move in interest rates, the more the fluctuation in the value of the bond. So the Fed hiking from 0% to 5% for a bill, like a 4-week bill or an 8-week bill, that will barely change the price of the security. For a 30-year bond, that will half the value of the security. And so if the banking system is flooded with all these bonds, then the hike in rates will cause a massive fall in the value of their assets, which is exactly what happened to SVB, which means that they have to hold more and more capital against those assets, against those bonds, right? But by keeping all the long-term bonds on their balance sheets, they ensure that the only thing that goes out into the financial system that gets flooded out into the banks are the bills, which are obviously you need much less capital to hold against. And so that's another way that they were basically like stealth QE, stealth liquidity during the taper to mitigate the effects of their own monetary tightening.
Yep. Why is the 10-year so important? And you see it, you see the chart, especially in the last few weeks with Trump playing the tariffs game. Why is it such a big deal?
The 10-year is important because it's a global benchmark for risk and for collateral, right? If you look at the yen carry trade, if you look at the European currency carry trades, even just like interbank lending, a lot of them will reference, especially derivatives contracts, will reference the 1-year, the 10-year government bond rate. And 5% is kind of like you could say like the Rubicon for the bond market when it comes to the long-term bonds, especially the 10, 20, and 30 years. And so us reaching 5% would be a signal of severe market stress. And right now we're at like 4.523 or something, last I checked. And so we're not too far off from there. And during the Liberation Day, or should we call it Liquidation Day, back in early April, we did see obviously a huge sell-off in bonds, and the yields on the 20 and 30-year were reaching 5% or almost 5%.
So we've seen Trump flip-flop a lot, right, over the last few months, pushing even some news through sources, and then seeing the market reaction, and then just literally pivoting overnight in his statements. What game are they playing? Because we see things that usually don't happen, right? The 10-year is getting closer to over 4%, staying around 4.5 in that range. And it shouldn't be theoretically it shouldn't be. So what's happening? Why are we seeing so many shifts in Trump's views, tariffs, and why is he backtracking so much?
I think he's backtracking because he underestimated the ferocity of the unwinding of the carry trade effects, right? The US has this unique position, obviously, as the holder of the world reserve currency, which means that we're the only country with external demand for our currency, right? No other country has that. But what that means functionally is essentially something that's akin to Triffin's dilemma, which means that we have to export dollars to grease the wheels of global trade. And all those dollars flowing out in the form of trade deficits or current account deficits or investments abroad or whatever it is, those eventually get recycled back into the US, right? Because if you're a corporation in Japan that makes cars, your Toyota or your Honda, if you're a Pakistani, textile manufacturer or an Iranian oil supplier, and you earn in dollars, then if you want to, you will eventually use those dollars for settling a debt or for international trade, for settling invoices that are cross border. But if in the meantime, you want to park that somewhere and earn a yield, and the typical spot to earn a yield for USD is obviously the USD denominated asset space, which is US equities, US bonds, US treasuries. And so all these countries were bidding up US assets with this positive effect of, you call it like the milkshake or the, Triffin's dilemma expanded effect for years. And once Trump came out with the tariffs, and especially once he came out guns blazing, was showing like he was willing to take things to extreme measures, like threatening China with 200%, 245% tariffs, that freaked everybody out. And it caused a very, very quick retracement in equities and in bonds, right? So we saw that We saw credit spreads blow out. We saw the 20-year and the 30-year almost hit 5%. I think the 20-year actually did pass 5%. We saw equities almost hit correction territory, and go through it actually. And so the market sentiment and the reaction was very severe and very, very quick. And I think he underestimated the impact of those flows, right? If we take away these global net buyers of U.S. equities and U.S. bonds, which is the rest of the world, via tariffs and via restrictive trade policy, then that means that this constant bid for American assets is no longer going to be there. And that's a dangerous thing, because that could cause a bear market, especially a severe one, at least in the short term, right? A 20, 30, 35% correction for 6 to 8 months. And if that happens on his watch, he's the one who's, responsible for that. And everyone will point to the tariffs as being the reason why. And that's politically, not very feasible, right? And so, especially when your main voter base is boomers who retire, their retirement funds and their 401ks are all relying on this, on these equities marching up forever. And so I think the ferocity of that move surprised him. It also surprised Besant and Lutnick. And so that's why they kind of backed off on their severe policy, said, okay, haha, just kidding, guys. We're not actually going to be as serious. And that's why they've now, I guess you could say, renormalized their channels with especially China or Japan and Germany, trying to figure out how do we proceed with some of our policy goals, some of the things that we promised our voter base, without destroying global markets. And what that probably means functionally is just a lower tariff, still tariffs, but something much more, we could say, lenient than they had previously imagined.
What do you see Trump doing in the next 3, 6, 12 months when it comes to tariffs, when it comes to policies within the U.S., but really, when it comes to the financial system?
Sure. Well, I think that, he is going to go ahead with his tariffs, and, his goal is potentially to, like we said, not do a, 5% or 10% tariff, but substantial tariffs, but then offset that with more monetary easing, right? More monetary accommodation.
But he doesn't control that, of course.
No, but if you've noticed his public statements, he's been calling for the resignation of Jay Powell repeatedly. And he wants to put in his, a replacement that would lower rates as quickly as possible, because keeping rates at, 4.5% or 4.25 to 4.5, which is the range that's at, that's still pretty tight. And he wants even more accommodation to be available for markets, because if, like we said, with the correlation with global liquidity or net liquidity, is if you have a tariff war, that's a headwind for equity prices. But at the same time, you begin an easing cycle, you could still see a bull market, right? Just maybe not as pronounced as the 2021, crypto DeFi summer bull market, but it would still be a bull market. And that could keep his voter base happy. That could keep Wall Street happy while, still maintaining the tariffs and, the more restrictive trade policy. And so that's what I think is his goal for the next 6 to 8 months, is try to find potentially a replacement for Powell, and or just, maybe more easily done is just urge Powell or force or twist his arm or whatever you have to do to get him to lower rates faster and to start adding some accommodation. And so this slowdown of the taper is just one sign that Powell's trying to kind of please him a little bit without seeming like he's fully beholden to the executive. But if Powell gets replaced, which Powell claims that he doesn't have the legal authority to do that, which is true. But if he gets the executive to replace him, and then the Senate will appoint a new Federal Reserve chairman. If that happens and the new person's accommodative, then Trump will have his wish fulfilled.
What's your do you believe that's a very realistic scenario in the next 3, 6, 8 months, 9 months, for basically Powell to either bend the knee or to be replaced by someone who would accommodate Trump?
I think the most likely scenario is that Powell will eventually be forced to bend the knee, but he'll do it in a way that's not as immediate or ferocious as Trump would want, right? Trump
Yep.
wants like very low rates immediately and QE very, very quickly.
Yep.
And he's going to, unless there's a crisis, he's
Yep.
probably going to continue with this slow and steady lowering rates every other meeting, and basically slowing down the taper until it's at a standstill, and then basically like slowly reintroducing easing, right? Maybe like
Yep.
20 or $30 billion worth of QE a month, which is like a fourth of what they did in the 2021 QE4. And
Yep.
so that's the most likely scenario, because everyone has called for the return of QE, and I agree that QE QE coming back is basically inevitable at this point, and a lower, there's never been a rate lowering cycle without QE in the last
Yep.
15, 20 years. And so just if we're going by historical standards, we're going to see much, much lower rates and much, much more QE eventually. The question is, how we get there. Because historically, what has happened is we've seen this steady increase in the Fed funds rate. Then there's a crisis and they drop rates to the zero bound, right? So they did that in 2008. They did that in 2020. They were raising rates for years. And then they finally said, oh, shoot, like, September 2019 repo crisis, start QE, and then 2020, obviously lower rates to the zero bound and do even more QE and just blow out the balance sheet. And this time, there's not a crisis that's appearing on the horizon that is immediately forcing the Fed to engage in massive monetary stimulus. It's just,
I think that's a very good point.
Yeah, it's a couple smaller crises here and there.
Yeah, I think that's a good point, and then I definitely want you to continue. But I think people are hoping for a Fed reaction like during COVID, right? Crisis, we have to change everything. And that's really not, I've been saying this on the show, that's not what's happening today. So maybe, and you see these fractals on Twitter, right? Oh, QE starting, we'll shoot up to $400,000 Bitcoin. How is this different? How is today different from what the Fed did in 2020?
So it's different in several ways. First, like, we're seeing the beginning of the structural, I would call it like a debt doom loop, or like the monetary event horizon, because in the aftermath of them hiking rates at the fastest rate hike cycle in history, the interest expense, the gross interest expense on the debt started to blow out. And what that meant is that we went from paying $1 billion a day in interest just in 2020, 2021 to $3 billion a day by 2023 and 2024. And now that means, obviously, if you extrapolate that over a year, that's over $1 trillion a year, which makes defense now the second largest line item in the U.S. fiscal budget. It just this week, it passed defense spending in terms of overall size. It's now at like 1.1 trillion.
Just servicing the debt.
Yeah, just servicing the debt. The defense budget, I think, is 1.087 trillion, and now the gross interest expense is 1.1 trillion. So it's bigger by about 13 billion now than the defense spending. And the next largest line item, which is the biggest, is Social Security, which is about 1.57 trillion. And so, if this cycle continues, right, the debt expense will be the biggest line item. And that's the conundrum that the Fed faces, and that makes this different from any other cycle. Is on one hand, they're trying to fight inflation that they themselves created in 2020 to fight COVID-19. And so to do so, they have to raise rates and be restrictive in their monetary policy. And on the other hand, they're saying, okay, well, we're fighting inflation. We're seeing this, increase. We're going to hike rates super hard, super fast, ratchet the gears in the economy, really tighten things up. But that blows out the debt. That blows out the interest expense, which means the debt spiral gets worse. And all that, interest expense will just keep ratcheting higher and higher and higher, and forcing the Treasury to issue more and more debt to cover the interest expense that they themselves are incurring. And that means, who's going to cover all that? Who's going to pay for all? Who's going to swallow all that debt? And, the retail base is basically tapped out. Foreign central banks are no longer really buying on net U.S. Treasuries. They're holding steady, or even in some cases dropping their holdings of U.S. Treasuries. And so the Fed has turned to the banks, the money market funds, and then also obviously foreign wealth funds to try to swallow up this Treasury issuance. And those are sources that are kind of working for now. But like we said, they'll eventually run out, and the Fed will have to restart QE. And so this just means they're trying to delay the inevitable as long as possible. They're trying to delay QE because they know that once they do QE again, especially with deficits at 2 trillion, which is where they're at
Yep.
now, like 6.5% of GDP, we're going to see inflation again in a big way. And that's going to make the Fed look extremely, extremely wrong-footed.
What time frame? So just to summarize everything, QE is inevitable.
Yeah.
QE will come back at some point, which will, of course, exacerbate the issue. Would you estimate between them coming back with putting QE in place and then having another round of, oh shit, inflation again?
Mm-hmm. Like when
what time frame do you estimate?
from when they start the QE to when
Yep.
the inflation comes back,
Yep.
that the lag is usually about 12 months to 15
Yep.
months. So if you look at the QE that we did in 2020, we began it in March 16th of 2020 in a very meaningful way. First, we announced like 90 billion a month, and then we said unlimited. We'll do as much QE as it takes, and that's finally the message that got markets to start retracing and moving up in a meaningful way. And it took from then until about early 2021, 1Q 2021 for inflation really to start to show the signs, right? We saw a little bit of movement in the fourth quarter of 2020 in the headline CPI, but due to the lockdowns, low monetary velocity, it was about a year. And so I expect if they do another wave of QE again, it would be about a year, maybe even less, maybe just 3 quarters for inflation to really show up in the data and for people to start to get worried again, because that this next wave
and we're back to square one.
Yeah, this next wave of inflation will be just as bad as the last one, if not maybe even worse, because we're starting this one with 6% deficit to GDP deficits. So like we're already at wartime spending, and we don't even have a recession. We're not fighting a war directly, right? We're just funding some proxy wars. And so that's a very, very, red alert, bad signal for me for the Fed's future direction. And so I think, once they start QE, it's going to be inflation here in pretty short order.
I think everyone watching this just wants to see, price going up in crypto, of course. How would that impact? I'm aligned on everything you say. I think it's going to be, we'll see QE, and then we'll see exactly back to square one. And in the meantime, though, because that's what people care about, is do my bags go up? What happens to crypto in this case in QE? Let's say QE in 3, 6, 9 months. What happens to crypto prices?
So before the Fed starts QE, you can expect some more short-term volatility, some more you can expect the market to be more sensitive to other pressures, right? So like we saw very clearly, right, when Trump started to announce tariffs, basically all crypto sold off initially with the general market sell-off. And then ironically, obviously, over the course of April, Fartcoin for some reason started to rip higher, and so people were using that as their store of value. And then obviously with Trump delaying the tariffs and starting to recant his earlier statements and to pull back the aggression on the trade side, we saw a relief rally essentially in markets, and that bled over to crypto. So we've seen Bitcoin finally break above 100K as talks have normalized between the US and China, and Ethereum starting to rip here as well. And so that shows that right now the picture's mostly trade and tariff policy focused, because again, the liquidity picture hasn't really changed. So all that's changing right now is sentiment, and sentiment obviously will change liquidity as asset allocators put in money or take out money based on their personal confidence in the markets. So for the short term, like 3 to 6 to 9 months, I would say just watch trade policy, because that'll be the main indicator. But long term, once the Fed starts QE, there will be a meaningful tailwind to equities and to assets and to crypto in general, because again, like we said, the spillover effects from liquidity will flow eventually out to the crypto markets. And so that's when the Fed starts QE, like the day they announce it, or they start lowering rates very, very quickly, like let's just say they start lowering it at 0.5% at each meeting, that's when you should really start doing your research, start finding some projects you like, start finding some companies, some names you like, and start investing, because the bull market will be coming, because there's like I say it, the best in one of my pieces, there's a massive price insensitive buyer coming, The Fed doesn't care about the price of the treasuries or the MBS that they're buying. And so
Yep.
all that cash gets pushed to the banks, which gets pushed to hedge funds, gets pushed to family offices and individuals who all, deploy that capital in this kind of rising, lifting tide environment. And so that means, it's going to be a very, very good season, I think, for crypto in general once the Fed starts QE.
I think people are super happy hearing this, especially from someone who does this all the time. What's your view on the summer? So you talked about tariffs really being, or sentiment and tariffs being really more of the focus. Would you historically the summer is always slow for crypto. What do you see? Mid-May right now. Would you think we see end of Q2, Q3? And then before basically the QE would resume, before QE starting again.
What do I see in regards to crypto specifically?
Yeah.
Well, I think the picture for crypto this summer is right. It's quite uncertain because I think there are still some things that have to happen to act as like positive catalysts for the space. One is obviously like the strategic Bitcoin reserve or strategic crypto reserve. Trump had promised at the Bitcoin conference last year to basically create this stockpile, and then they expanded it with proposals to actually add Solana and what was it, Cardano and like ETH,
XRP, I think too.
XRP, like half a dozen cryptocurrencies plus Bitcoin into the strategic crypto reserve, and basically allow the government to acquire this asset, in a real sense. And one way, many people have asked, well, how could they do that? You just talked about their fiscal situation, $2 trillion of deficits, $37 trillion of debt, $1 trillion of interest expense a year. How are they going to pay for that? And, one theory that's propped up, which is, I think, actually quite interesting, there's some credence to it, is if they revalue the gold reserves that they have on hand at Fort Knox, they would gain about $850 to $950 billion of liquidity, right? Of like an asset on hand that they could borrow against or they could sell. And that's potentially why, and I've put this out on my Substack, I've done some research on it. I think that's potentially why the gold price is moving so aggressively higher right now. Is because if you look at the import-export numbers, the overall import numbers for gold from the US is about 1,300 tons for the first 2 months of this year, right? But StoneX, which is the main exchange that handles import-export for the gold exchanges like COMEX, StoneX reported that only 700 tons of that was used for exchanges in the US. And obviously there's a very, very short list of individuals who could import literal tons of gold to the US. And so the other 800 tons has to come from, somewhere, right? Or 600 tons. And the most logical conclusion is that due to trade policy regulations, what's something called monetary gold doesn't have to be declared, meaning like they don't have to, when they import it, they don't say like, oh, this is specifically going to this place, right? This is just
to the gold reserve, basically.
They just call it like excess gold import. But the only like type of gold that can get that designation is called monetary gold. And monetary gold are gold bars that are like 400 ounces or more. So huge standardized serialized gold bars. And the only people who really use gold, monetary gold, is Fort Knox and the Fed. So it's the Treasury and the central bank. And so those two entities, if there's that much gold imports in the first few months of this year, that tells me that they're refilling Fort Knox. And so that means that they're potentially getting ready for something like this, right? They can revalue their gold reserves, get an $800 to $900 billion asset overnight, just like that, because we're revaluing it from $42 an ounce to 3,300 or wherever it's at right now. So it's like a huge jump in the value of their gold. And then they could use some of that money, right? Which I think would be smart, because gold, although it's a great asset, you don't necessarily need $800 billion of it. And so you could shuffle some of that money into a strategic crypto reserve and use it to buy some of those assets. And so if that's truly, which is, again, this is all kind of like speculative because we're just putting together the pieces, and I have a couple podcasts on my Substack with some experts and some pieces on there if you want to check those out. If you're a listener and you're interested.
Yeah,
But
we'll definitely link this upside for sure.
yeah, of course. But
Yep.
those are kind of the pieces in play. So the
Nice.
big news is, right, if we get that strategic crypto reserve, I think we could really see more capital flow into the space,
Yep.
even without an easing cycle. Just
Yep.
regulatory clarity that we've already had, plus this like tailwind of the federal government having a crypto reserve. I think that would be massive for crypto. So watch for that going forward.
Okay. 5 minutes left. I want you to tell us about the documentary and Tokyo. And then the last question that I ask every guest on the show is, what's your price prediction for this cycle? But first, your documentary. So tell us more about the docu.
Sure. So we filmed the documentary about the Japanese yen and Bitcoin, essentially, and crypto in Tokyo in March and April of this year. The goal of the documentary, I've been writing about the Japanese yen actually for years. I've been doing research on the Japanese economy and documenting this like slow motion train crash that is the currency crisis that is faced by the Bank of Japan. And this story has been getting increasingly prominent in the last few years, especially with the emergence of the yen carry trade, right? All of these traders using excess liquidity from the Bank of Japan, the 0% interest rates, to borrow yen and then to buy USD and to funnel money into US capital markets. And so I wanted to kind of explore this problem more deeply and understand the Japanese economy more deeply. And so we made this documentary, and it was sponsored by Metaplanet, which is they're essentially a Bitcoin holding company.
We cover them a lot on the show because everyone on the show knows them because they keep buying Bitcoin.
Yeah, exactly. Yeah, they do. And they're a real estate company. They have hotel chains in Southeast Asia and in Japan. And in 2024 they started buying Bitcoin in a huge way. And since in Japan the regulatory environment is so hostile to Bitcoin, I think to own Bitcoin outright, like for yourself, you have to own it through a corporation, and you have to pay a 55% unrealized capital gains tax. So it's just an insane, like, it's very difficult to do for the average retail investor. And so with Metaplanet coming on board and saying, hey, we're just going to buy Bitcoin on a balance sheet, that allowed basically retail investors and even institutions to finally have a Bitcoin proxy available in the land of financial repression, right? Which is 0% interest rates and 0% inflation, which has been Japan for the last 30 years. And so their stock has done incredibly well. The whole team has done incredibly well. We got to meet everybody. And so that documentary hopefully will be coming out in June. I'm also going to be producing a long form video about it on my YouTube, which should be coming out, in the next month or so. But yeah,
we'll definitely link it when it's out. I think that, again, it's very interesting to me when people take the skill they have, which is finance for you and understanding the system, and actually producing books. I know you also wrote a book, one book or more than one?
One book.
One book and a documentary. So
Yeah.
we'll link everything. I see it on Amazon. It's the dollar Endgame. Hyperinflation is coming. Well, basically, some of what we covered now in the show. Last question about actually two things. One, price prediction, because people love that, and then anything that you would want, anything you want to mention as closing, closing statements before the end. So, what do you think? This is the question people love to. They want the answer from every guest, and answers are very different. But what do you see Bitcoin hitting in terms of price, and maybe other cryptos, but mainly Bitcoin? What is your price
is this for just this cycle, or for
this cycle? For this cycle.
For this cycle. Yeah, for this cycle, I think we're still in this doldrums of institutional adoption, like waiting to get the institutions on board fully, and potential nation state adoption, because I think the nation state will be the true, you could say, like turbo or nitrous in the booster rocket to get us to insane 1 million, 2 million, 5 million a coin, right? But in the intermediary, like as we see these Bitcoin treasury companies become kind of a meme, and every single company wants to start issuing converts, right? We just saw GameStop issue a Bitcoin convertible bond in early April, so just about a month and a half ago. Saylor obviously doing a strategy. I think that the terminal price for Bitcoin at the end of this cycle is somewhere between $250 and $350,000. So not an insane jump this cycle. If you go from the beginning of the cycle from 20K to that is actually, obviously it's very good. But yeah, 250K, I would say on the conservative side would be probably pretty reasonable, especially if you get more and more Bitcoin treasury company adoption, especially from one of the big boys. And so it really just depends, right? The path that it takes and the overall openness that corporate America has, and the corporate boards across the developed world have towards this asset, because Microsoft got that shareholder proposal last year. They shot it down. Several other companies have had shareholder proposals to buy Bitcoin. They've been either not ignoring them, or even like GameStop, they've been slow to adopt Bitcoin, which is unfortunate. But there's, like, for example, there's an SEC ruling just this week showing that Microsoft could buy Bitcoin without a shareholder proposal or shareholder vote, because they could deem it as a business activity or a necessary business activity for investment. And so that opens the door. That ruling opens the door for more and more companies to start to adopt a Saylor strategy. And so I hope that they don't necessarily need to do the convertible bonds, but I hope that more companies start to put some of their excess cash into Bitcoin or other inflation hedge assets, because like we said, inflation is going to come back in a meaningful way. So that's my price prediction for this cycle.
250 to 350K.
Yeah.
Great. Anything else you'd like to add that you'd like us to? So we'll link everything. Please send us all the links that you want. So Substack, the docu when it comes out, the book, of course. Anything else that comes to mind, or that you're looking at in the market right now?
Well, right now I'm looking at the the trade policy between the U.S. and China, and especially doing some research on the Chinese economy, which I think, so when we're talking about this, like this global easing cycle, global debasement, we're really talking about something that's known in macro as a globally synchronized growth, right? And this essentially means that because the Federal Reserve is the holder of the world reserve currency, and because they're the benchmark from which the rest of the world is judged, most other economies actually follow the Fed in terms of like their central bank policy dependence. So if the Fed is easing, they're easing. If the Fed is hiking, they're hiking. And so this leads to this globally synchronized growth narrative, or globally coordinated monetary policy narrative. And two of the large countries that have been kind of bucking the trend are China and Japan, the East Asian tigers. And obviously for different reasons. Japan wanted to keep rates at the zero bound because they have 260% debt to GDP. They can't really hike rates when the Fed starts their rate hiking cycle. But China, for different reasons. So China's fighting this deflationary wave from this property collapse. And so one thing I'm looking at is, will China be forced to do a massive wave of QE before the Fed, because they're trying to deal with the issues in their banking sector and in their real estate sector, and basically stop the deflationary train from taking hold in China, in that Asian behemoth. And so I think that is a possible catalyst, right, for, you could say, like a higher equity prices, higher crypto prices, is if China is forced to do $1 trillion or $2 trillion of stimulus in short order to save their housing market, that liquidity could flow out and impact the rest of markets. Yeah,
I fully agree on, the U.S. leads, right? For better or for the worse, they lead policy. Every other country in the world looks at the U.S., and no one wants to be the first to make a mistake. So if the U.S. does something, Europe will follow. I think a lot of people don't understand, especially those who are new to just how the world works in general. It's always the big countries and the big boys, mainly the U.S. and the West, that almost give smaller countries in Europe or South America the excuse to follow the U.S. because okay, if the U.S. does it, it's okay. Any big move will, yes, we see European central banks changing policy before the US recently, but the truth is no one cares, right? Everyone's looking at the US. They are the dominant player, of course. And of course, China too, with the issues they have locally.
Yeah. Well,
Yeah.
like, look, they can be like the ECB, they started, cutting rates in June and the
Yeah.
Fed started in September. So, it's
Yeah.
like, yeah, okay, they can be a little off. You're right. It's not like we said earlier, like, don't extrapolate this like you would with global liquidity. Oh, it's like, oh, it's up today. Markets
Yeah.
must go up. It's like, no, no, no. Of
Yeah.
course,
Yeah.
there's sentiment and there's bullish, bearish, like emotional driven trading. Like anything
Yeah.
can happen. But it just means that structurally, like if the Fed is in the middle of an easing cycle and they're in the
Yeah.
middle of a hiking cycle, things are going to start to go awry in their own
Yeah.
domestic financial system. So they can't,
Yeah.
just like a sine wave, they can't be completely offset from the Fed. They can be a little
Yeah.
offset. They can do their hiking a little earlier and do their cutting 3 months or 6 months earlier, but being at the
There is a
completely wrong
trend.
side of it. Yeah, being on the completely wrong side of a Fed cycle means that your interest rate policy will be
Yeah.
way different from the Fed's. And that's
Yeah.
dangerous because that can open up the carry trade effects, which is exactly
Yeah.
what blew out Japan's currency from 100 to 150 within 2 years at the fastest rate since the Asian financial crisis. So
Yeah.
unless you want that to happen to your currency, which most countries don't, then you have to be in line with the Fed and roughly in what they're doing.
Yeah. Great conversation. I think this was super valuable to everyone. I learned several things, so thank you for coming on the show. We'll link everything, like I said. Definitely want to have you back, probably at the end of next quarter or something, once we've seen kind of things play out over the summer. Trump is very Trump brings excitement to the market, good or bad. There's never a day without a Trump headline. So I think it'll be interesting to see, especially after the summer, as we head to into Q4. I think that'll be a very interesting time, especially with Jerome Powell, of course, coming to the tail end of his time. It's things are going to be moving a lot. I think overall, I always say that people have to be patient because I'm fully aligned on everything you said. I think it's a matter of time. QE needs to happen. It's just a matter of when. You just have to survive, be patient. Prices will go up, barring a catastrophic global event. The number of your bags will go up. You just have to be patient and let things play out.
Yeah, exactly.
Yeah, appreciate having you on the show. The Peruvian Bull on Twitter, Peruvian underscore
Peruvian
Bull.
underscore Bull on Twitter and YouTube. And then, like you said, I have a book. The book was actually initially written on Reddit. I wrote
Nice.
I wrote the first part of a thesis, of a macro thesis, and everyone's like, dude, this is so good. Write the next one. And
Very
so
cool.
I wrote 15 posts that were all structured in 7 different parts, describing the macro, the macro dilemmas that the US faces right now. And everyone loved it so much they're make it into a book. And so for people who are watching, if you want to read the book and buy it on Amazon, that's great. That supports me as an independent creator. I appreciate that. But you also don't have to. I made it for free online. So it's on Medium, it's on Reddit, there's a Google Doc that is linked somewhere. You can find it.
Nice.
So yeah, you can go find it for free.
Yeah, we'll share that with with our communities too.
Yeah, of course.
Very cool.
Awesome. Thank you so much.
Great having you on, and we'll definitely have you back. Thank you for your time again. Thank you for being on the CoinRock Show. Thank you for following the show. Definitely check out everything that Peruvian Bull puts out. You'll see, for those who've been on, and who follow us for months now, it's very much my views too on the market. Survive. Better times are coming. Your bags will pump. Just survive. Be patient. All right, guys.
Exactly.
We'll catch you next time. Hey, thanks for watching. If you got value from this episode, you're going to love what's coming next. So subscribe now. We drop new episodes and videos several times a week, featuring power players, market movers, and insiders from the financial world. And if you want access to deals and insights we only share privately, hit the links in the description, and we'll see you on the next show.